Yeah, good evening, everybody. We'll start the session now. On behalf of Nirmal Bang Institutional Equities, I welcome you all to the session with EIH, represented by Mr. Korol Kundu, who is the CFO. This is part of our week-long investors conference. At the outset, I'd like to thank the management for joining us and giving their time today for this conference. I would request Mr. Kundu to start the session with some opening remarks about the business environment as it is today, after which we can open the floor for Q&A. Thank you again, sir, and over to you.
Good evening, Hitesh, and thank you, Rahul, and everybody else from Nirmal Bang for organizing this, and welcome to all of you. Well, about the business environment, I think the momentum that really got started in the Q1, by and large, continued through Q2, and the trends seem to be following in the following quarter as well. Although we are currently in the middle of the quarter, so we don't want to really jump the guns before it gets completed. But corporate business has picked up substantially. We are back to pre-pandemic levels in most cases. Rates are marginally higher than what they were in pre-pandemic levels in general. The other question that really comes to people's mind is the foreign occupancy. There again, in general, the trend has been that barring UK, which has some visa-related issues, all the other major economies that really contribute towards our business are almost either are equal to what it was pre-pandemic, or they have crossed those levels as well. So yeah, all in all, I think it's business is gaining traction as we move along the financial year. And of course, if there are any specific questions, I'm happy to answer. Thank you so much.
Yeah, thanks, sir. We'll have the Q&A session now. Participants, if you want to ask, you can use the raise hand function of Zoom or come in directly by introducing yourself and your company name. We have the first question from Dheeraj Sachdev of Roha. Please go ahead, sir.
Yeah, hi. I just wanted to know, I mean, this appears to be one of the best season in the last decade or so, or prolonged issues and stresses in the hotel sector as such. So can you elaborate how much has been the room supply from our end, and what is the kind of occupancy we can see? Because I guess this next 3-5 months will be one of the peakest season that we would see, right?
Yeah, thanks. I'm sorry, just to clarify, did you ask about room supply?
Yeah, how much has been our room supply right now?
Well, there's no change in the room supply as of now. There's no change in the room supply in our case as of now. In the previous earnings call, our CEO and Managing Director actually articulated that there are several projects which are in the offing over the next 4 to 5 years, and in what stages they are. So if you speak of this particular period, there is no change in the room supply, but over the next 4 or 5 years, there are several projects which are on the anvil. About 14 of them which are concrete projects which are either under planning or under execution stage. And there are about 8 which are under very active discussions, for which we should be able to make announcements in the next 3 to 6 months. As regards to occupancy, I think you asked about that. Obviously, it's drastically different from what it was, let's say, even in pre-pandemic times. So if I were to look at, let's say, Q1 and Q2 alone, then let's say in Q1 of FY20, where it was about 65%, and I'm talking of EIH hotels only, not the group hotels. We completed Q1 with about 79% occupancy, and the ARR was also higher. Q2 also against about 67% occupancy in FY19-20, we did 77% at a 20% higher ARR. So if that really helps to give you a trend.
Yeah, so this 20% IRR is what in absolute terms?
For Q2, our ARR for EIH hotels was 12,000 rupees odd. And of course, if you take all the group hotels, it will be slightly different because we have villas properties and all as well. So
yeah,
let's
so
see.
all put together, how much will be the average for us?
Sorry, I didn't get your question. Sorry.
So for all put together, including villas and other properties and budget hotels, how much will be the average yield for us?
Average room rate.
Average, yeah, room tariff, yeah.
Yeah, so that will be pretty high because, I mean, that's actually a hash total. I don't know if you really want to know that, but that's really a hash total because that's not what goes into EIH P&L. But if you're keen on it, it'll be close to 20,000.
Okay, and just wanted to know, because you have active discussions for 8 new properties and 14 more in the planning stage you mentioned earlier. So how much do you think is going to be on a service model? For example, earlier there was a time, decade back, where people were constructing hotels. It took 3 years for the construction period, and a lot of debt burden happened, and the break even followed much later, and the ROCs were dented. Do you think hotels have come a long way in terms of maturity, where they are taking over budget hotels on a licensee arrangement without capex and lending their brand? And is this a way to model ourselves now going forward?
That's a good question. Now, this really depends from organization to organization and group to group. Some hotel chains do have that philosophy of getting budget hotels, etc. We are really not into the budget hotel space. Very clearly, we are either in the luxury segment or we are in the in the upper upscale segment, not below that. So basically, our Oberoi Vilas, Oberoi brand, and our Trident brands. So frankly, in our assessment, that segment, the upper upscale upwards to luxury, is really going to be the cornerstone for us. So with that in mind, we have different kinds of properties among these 14 properties or the 8 properties which are under contemplation. There are 3 properties which are own properties, where it is our own land, where construction has already begun, or it is an active planning stage, or it has considerably progressed. For example, the Oberoi Rajgarh Palace will come. It's already quite advanced in the stages of construction, and by 2024 calendar year it should open. So that's Rajgarh, which will be a property which is a very sort of niche property at a very high average room rate. It is a comparatively smaller property with between 50 to 66 rooms, and it may be opened in stages, but the ARRs will be very high in that property. Likewise, the Goa project is already on, where we are coming with 1 Trident as well as 1 Oberoi property, and that land again belongs to us in South Goa, with our own beachfront, etc. The third one is we have a land at Hebel in Bangalore, where again this property will be a mixed-use property. But whether we will do it on our own balance sheet or whether we will do it with a joint venture partner will be decided in the next 2 or 3 months. But again, whoever does it, the planning and all is in progress. The rest of the projects are management contracts. Now, to generally say whether the hotel industry is come of age, again, like I said, that everybody has their own philosophy. Some hotel chains like to go only the management contract route. Of course, management contract route is capital. I mean, it doesn't require capex. So that's one advantage. But one thing which has taught the industry, I think, is that at the end of the day, the risk that we try to avoid by getting into management contracts, which is to say that, if there is a loss that the owner makes, then the operator doesn't have to bear a share of that. Now that, to my mind at least, has proved to be a myth, because what we've noticed is that at the end of the day, if there is a loss, whether the operator bears a share of that or not, even if it's a management contract and the owner has to bear the loss, I think the result is still the same. Because eventually, if it goes on for a longer period, then nobody will be able to sustain that loss. So just to round up the whole point that you mentioned about debt as well. So in our case, actually, the debt has considerably come down now. It is sub 200 crore levels, where it had reached a peak of 600 crore during the COVID period. And by the year end, we'll have to see whether any debt at all remains in the book. So we do have a lot of appetite to even take debt. Our general policy is to have 20% debt equity. And if we are a zero debt company by, let's say, in the next 6 months or so, then obviously we will have enough appetite to absorb the capital that will be required for our own projects as well.
Sure, thanks for that. And just broader industry question. While this year has been good, and we had typically very prolonged kind of issues in the last so many years. What do you estimate whether this higher occupancy levels and demand will last longer? Is the demand far greater than the supply creation? The supply cannot be created very easily now. So do you think it will be a very elongated thing, or is just a pent-up demand after COVID, people rushing out to holiday, and that's not going to last beyond a year or so?
No. See, I think it's very clear that, this pent-up demand, I don't think any industry insider uses that term anymore, because initially we did think it was pent-up demand. And I think that was applicable last year when after the second wave, when it opened up, people started traveling and all, and we saw leisure business really growing by leaps and bounds. But the current year has been on the back of corporate and direct business. So therefore, our city hotels are actually really firing from all cylinders. So I don't think there is any question of any pent-up demand. The country is growing at a reasonably good pace as compared to competition. Traveling is happening, flights are chock-a-block. I don't see that, that calling this as a pent-up demand is a very prudent thing to say. Although we will always be conscious of the fact that risks could emerge from any sector, whether it's we don't know what's going to happen in Ukraine tomorrow. So barring those unforeseen factors, or let's say risks of inflation, which again we all know, the way it's panning out in India vis-a-vis in countries abroad. But barring all these factors, generally speaking, the mood is optimistic.
Yeah, I agree, Kalol, but we need to be more specific. I mean, can we assume with a lot of conviction that it can long last for 3-4 years?
We certainly do believe that is the case.
And that's
which is why we are also pressing the pedal on our projects to make sure they also get completed fast and we come up with inventory. So we do believe that there is reason for optimism for the next few years.
Okay, and just one last thing from my side. I mean, a lot of things are now getting into service model as well. Like if I have to coin the word hotel as a service. So is a restaurant business, which is typically 40-45% of the total revenue, are we also catering to the outsiders as a service?
No. So if you're talking of home delivery, etc., which was really one of the models which in COVID people used, we are not very keen on the home delivery business, because we've seen that currently the restaurant business itself, the food and beverage business itself is so buoyant that there's hardly any scope for doing home deliveries, etc. The second is that, as you would be aware probably, that we as a group have also started our first cafe in BKC, which is a standalone cafe. And shortly we are going to launch a standalone restaurant as well in BKC. So therefore, I mean, I don't see us going the home delivery route, if that is what you were referring to.
Just as a peer comparison, Taj obviously has some model on the restaurant side as well to cater to the outsiders as well. That's where I'm coming from.
No, I think I won't talk about competition or Taj, but obviously they have their own branding and the way they want to do it. But we are very clear that we would like to concentrate on our hotel business, which is what really our customers and our guests expect, and it's profitable from our point of view as well. So we are very clear. I don't think competition really has standalone restaurants, but competition and other industry groups do continue to do home delivery, etc., which we really do not encourage.
Okay, just a final one. So if the peak revenue and occupancy reach in terms of peak tariffs and peak occupancy, what kind of peak ROC we can do? Any estimate there?
Well, ROC as a group, it's difficult to say directly. Now, the way we look at it from our management appraisal point of view is we divide it internally into strategic business units. So there's one which is the flight catering business. There is one which is the hotels, and within the hotels also there is. So typically what we do is we look at the ROC for each hotel. And let's say hotels which are matured, for example, either renovated in the recent past, or at least not so old, meaning they are, let's say, 10 years, 12 years, 20 years, where the asset base is comparatively lower. I think those properties are at a very high ROC ranging from anywhere between 40 to 60%. But the newer properties where renovations may have just happened, or there's a new property which has come in at a considerable cost, there also the ROC would be somewhere in the range of, let's say, 14 to 18%. We definitely, at new properties, we definitely try to make sure that our hurdle rate is more than the weighted average cost of capital. So
sure,
I think to give an ROC for the whole group would be erroneous, because you would have to divide it into the various SBUs.
Yeah, I mean, as investors, we are coming in a consolidated business, which includes flight catering and others as well, including new and old. So we don't want to distinguish that, because we look at consolidated ROC number. While you may justify that the old mature ones will have higher ROICs, from investors' perspective, one has to ensure that the ROCs are much higher than the cost of capital.
No, I agree with that. But there, Dheeraj, I think what needs to be also kept in mind is we have stated that in the beginning of the year, we stated that we would be looking at our assets which are low yielding assets. And we've really managed to keep our word to that. So we've already, one asset has been already disposed of, which was really low performing. There's another one which has been a loss-making asset that, of course, comes into as an investment in the books of standalone. But that is also been publicly declared, which is on the transaction is about to complete in the next few weeks. So when you take a futuristic view, I think it is important to consider the fact that the management is very clear that we are looking very actively to either turn around or look at other means to monetize our low yielding assets. So that should be kept in mind.
Yeah, I think that's the right strategy to monetize any property which is yielding lower than the cost of capital. Great. Thank you so much, Kalon. All the best.
Thank you. Thank you so much.
Thank you, Dheeraj. A reminder to the investors, if you want to ask a question, please use the raise hand function of Zoom or come in directly by introducing yourself and your company name. Yeah, Jayesh bhai. Jayesh Gandhi from Baroda BNP Paribas. Please go ahead, sir.
Hi, good evening. Thank you for the opportunity. Am I audible?
Yeah, Jayesh, please. Thank you for coming on the call. Thank you so much.
Yeah. So, couple of questions. First is that for next year, that is FY23-24, what is the room accretion that we will likely to see based on your current plan in terms of percentage?
Well, not much. Our accretion of room inventory will start coming only from FY25.
Yeah, but 24 would you have a number that you can share, or it will be like low single digit?
Yeah, it's not really much. I would add that there are some renovation rooms which are there in the pipeline, which has already actually been released. So these are the 10th to the 14th floors in the Trident Nariman Point, which was earlier either kept shut or were sold at only when there was an extreme peak, because the rooms weren't renovated for a long time. So that additional inventory has come in. That is about 160 rooms.
Right. So in 24-25, when you see the actual increase in volume or capacity, as you call it, and at that number, and from 24-25 onward, what would be the annual increase that one should look at?
So Jayesh, our group's philosophy is really speaking. I know where you're coming from here, and the question is probably looking at an industry viewpoint, but our philosophy is slightly different from the way, it's not really talking about the number of rooms getting added. It's all individual, different properties, and each have their own rationale from a business perspective, right? So what we believe is that rather than having a 100-room hotel, let's say I'm saying that I'll add 400 keys, it's really not very meaningful for us, because when I say 66 rooms of Rajgarh, that'll probably, we are looking at an ARR of anywhere between 35,000-40,000 there minimum, right, to begin with. Now, if I add the 66 to let's say a 200-room property, which earns an ARR which is much lower, let's say 15,000 or 12,000 rupees, then it won't be right to count. So if you could please excuse me for not getting into the number part of the story, but I'll give you a flavor of what we are talking about. So there are several projects, and I hope you have access to the document that was shared where we listed out the projects in the last earnings call that are going to come. So you would find that there are several projects which are either being done by EIH itself, or there are projects which are being done by some of the either the subsidiary or the associate companies of EIH. So, for example, there is one project in Tirupati which will be done under Mumtaz Hotels, which is currently owns only one hotel, which is the Uber Amar Villas. There, EIH has a 60% stake, and EIH is also going to manage those hotels. So, if you really want a number, I can probably add up the numbers and give you a number, but that won't be very meaningful. But the projects are as we defined out in the last earnings call.
I understand. Fair enough. No, I guess where I was coming from is that from ARR point of view, there is only that much higher the increase that you can get, probably in the double digit, but still, you know, what do you call, a finite number. It is the volume and a combination of volume and tariff increase, or that will lead to your higher top line growth, which is something that you want to aspire to do, if not next year, then the year after that.
So Jayesh, I would say here that, you know, we are really way more focused on earnings per share, and let's say, you know, the profitability is more important to us than the revenue growth itself, because we actually speaking, it is slightly the other way around. We are trying to position ourselves, or at least we that's what we believe we are positioned as, even during the pandemic, where we did not really reduce our room tariffs too much. The whole idea was that our positioning needs to be luxury and upper upscale, and therefore a higher ARR actually fetches a way higher flow through to the EBITDA. So occupancy really to that extent doesn't help. So so ARR is actually the route to follow insofar as we are concerned. So the addition in room inventory will happen at a level at which we can maintain our service levels, etc. But we believe that we have a potential to get a much higher ARR than the market in general.
So if you were to give me a clear number, next year rise by double digit?
Sorry, Jesh, your voice was breaking off. Your voice was trailing off.
Okay. The question I'm asking is that for the next 3 years, will our ARR rise by double digits year over year?
Yeah, I heard your question. Difficult to put a number on whether it will be double digits or not, but we do expect it to be a formidable increase, is what I would say. And especially the properties that we're looking at, the positioning that we are looking at for our new properties, it will not be plain vanilla properties.
Understand. I did not mean year after year, in the sense a 3-year target would be more than double digit.
100%.
Wonderful. Now that's good to hear. The other quick question I have is, and it's very difficult to gauge margins, because the seasonality of the business is so high. First quarter versus second quarter, and then third quarter being robust, etc. So if I take a year as a whole, will our margins FY24 and forward be better than what we have achieved, or are the margins peaked?
No, margins will definitely be much better. But if you really look at numbers, Jayesh, that quarter one actually EIH Hotels did a 78.7% occupancy, right? Never in the history of, I think, the industry has such kind of occupancies happened. Right. One may say attribute various factors to it, but really speaking, seasonality, I don't know, in the current year at least, seasonality has not played any role, or very limited role, I would say.
Yeah, but in the quarter two, you had expenses also come up, right? So maybe some expenses were not there in the quarter one, but if you see quarter two margins, they were lower. So, and I know margins can fluctuate quarter over quarter. So I said, I'm asking you for the full year, that year over year, you will see margins improving?
100% it will improve, because the cost reduction that happened during the COVID. So one side, the ARRs are higher, and therefore flow through to EBITDA is higher. Volume of business is higher. That again contributes. And the third thing is the cost rationalization that happened. We've been able to sustain it. We mentioned that we would, as an example, let's say our payroll cost would, or our fixed cost would be down by 15%. We continue to be at a 10% reduced cost than what we were before. even after the increases that we saw in the current year. Increases due to higher consumption cost as well as higher payroll costs because of attrition, etc., which all industries have been witnessing. Even after that, our overall costs, fixed cost is 10% lower than what it was.
Okay.
So obviously, margins have to improve.
Probably, and then we'll see the reflection of that in probably Q3, which is kind of the full-blown quarter for you.
Absolutely. Q2 also, if you are looking at EBITDA, it was a different story. But Q2, one of the other reasons is that we are also looking very carefully to make sure that we don't carry any assets in our books, which are really, we are looking at very, refining all our balance sheet as well. So therefore, you would find that we are looking at our asset values much more closely. And if there is any scope of any impairment or any reason where we believe that investments may be lower, we have not hesitated to carry out impairment. We want to do that. We want to be absolutely sure that the value that we are carrying in books is what we can realize. And I think one of the reasons you would have seen some impairment happening in the Q2 as well. We don't expect any such further impairment to come. But if it, that's also one of the reasons why our bottom line may look a little different than what it should have looked.
Understood. So ARR increase and margins is how we should focus and see improvements going forward, is what I understand.
Yes, ARR, margins, and reasonable growth. I would not say we would do a runaway growth, but we would definitely do reasonable growth. And we believe by that, we can remain market leaders, both in terms of, service delivery, as well as STR rankings, as well as at the end of the day, profitability to our shareholders.
Thank you for the feedback. Always a pleasure talking to you. All the very best, sir.
Same here, Jayesh. Thank you so much.
Thank you, Jayesh Bhai. The next question is from the line of Aishwarya Deepak of Nippon AMC. Please go ahead.
Yeah, thank you very much. Sir, just wondering how is the occupancy and ARR doing for us at this point of time versus Q2?
It's similar, Aishwarya.
Because I understand from few people that right now the ARR or the day rentals has gone up by say 20-25% versus.
No, I thought you talked about occupancy. ARR, of course, has gone up substantially.
So 20-25% is the number which I hear from the different sets of people.
Well, versus Q1, it would be around 35-40% range. If you compare it with Q2, it will be around 20-25% range.
Okay, and that's very good. And what is the outlook? I mean, we are already in the very strong season, November end. So should we expect this to continue for the remaining 3-4 months, or do you see even further upside from here, especially in this next say 2 months, because here we have the strong season.
So one of the policies that we have is we don't make forward-looking statements, but I can give you a trend of what we believe it will be, and this is based on circumstances. So there were concerns earlier about foreign occupancy, about Indian occupancy, etc. We have seen foreign occupancy also rebounding back to pre-pandemic levels, as I mentioned in my opening remarks, except for one country, which has its own problems at the moment. But if that really is looked at, then we can safely say that if foreign tourism really goes back to pre-pandemic levels, especially in the last quarter, then there will be further pressure on the rates, and obviously that will help improve our margins even better.
Sure, and sir, that's good to know. And how do you see the order booking or the visibility of revenue from here on? Because now we are in a season, and probably you can give some. How do you see the next 4-5 months booking or the inquiries by the customer or maybe the foreign travelers?
No, it's very robust. As I said, the trends are very robust. The business on books is quite strong. Contracting also has been happening at a very decent pace. And obviously, the stagnation that was earlier there, of course, there are inflationary pressures, that I must say. But subject to that, I think people do understand that especially these two sectors, hotels and aviation, are doing very well in terms of demand. And we are certainly reaping the benefits of that at the moment.
That's good to know, sir. And sir, in this part only, how do you see the corporate booking? Because one of the biggest lever was the corporate bookings, and the rate of the corporate booking supposed to move up in a meaningful way. And there was also there are some revision in the rates on a global basis, which supposed to happen from 1st of April. Where I understood that 15% kind of hike is the minimal one should expect from 1st of January.
Well, as I said that, I won't be able to give specific numbers, but if you take in general, corporate business is still about 35% of our business. And if we are saying that we are going to do an ARR, which is, let's say 35-40% higher than first quarter, and obviously a large portion of that has to come from the corporate segment as well. Of course, direct segment is the most profitable in terms of higher ARRs, but obviously if a large chunk is in corporate segment, then that rates have to also similarly go up. So from that, I think you can get an indication of where the rates for individual corporates are. Sorry, Ashwin, your voice is breaking. I can't hear you clearly.
Yes, sir. If I divide the revenue, then what we discussed is some 35% is the corporate. What is the remaining 65%? If you just give us the breakup.
Well, the largest chunk is direct business as of now, which is from our own website, from our contact center, and from online travel agents. So that is the second largest segment, followed by leisure. Yeah, that's about, and the rest is MICE. So conferences and MICE is also picked up quite substantially.
So, and sir, with this improved activity, where you have the better IRR, and I hope the occupancy will also be good. So in that case, I expect that the cost should move up, because there was too much rationalization of the cost because of the COVID, because the revenue was not there, and it was a logical step. But now with such a decent rate and a decent occupancy, how we should look at the cost versus pre-COVID?
You know what? Actually, the costs were not reduced per se, but they were rationalized. So a couple of things happened. One is that as a group, we invested heavily into technology over the last 3 years, and in fact, that process had started even before COVID really kicked in. So we got the benefits of that, and that really led to a lot of savings that we did in terms of reduced manpower, where we did not have to fill up the positions that were vacant, because it was replaced with technology. So as a result of many of these actions, as I mentioned earlier on, the payroll cost is lower by 10% than what it was in a pre-pandemic period. Now, this is even after the addition of employees, for example, for contracted employees and others, where because of enhanced business, more people had to be taken in. So the reduction that I'm talking about is even after taking that into account. So really speaking, and then there are several other measures. For example, we went with solar plants, which is not only a good thing for us from an ESG point of view, at 4 of our hotels, where between 40 to 60% of our electricity, for example, is completely at a negligible cost compared to the normal tariff, which is between 9 to 11 rupees anywhere in India. So I think many of these cost levers, these are at least semi-permanent in nature, if not permanent, and therefore we don't expect those to arise. In terms of variable cost, which is high because of inflationary trends and other things, we are keeping a very watchful eye and making sure that our supplies, etc., are not affected. And there also, we are in a better position to negotiate with our vendors, for example, because in the good old days when systems were manual, let's say we were not in a position to really, I mean, the question of, let's say, timely payments to vendors. Now that does offset a bit of the price increase as well, because now we can promise to vendors, for example, that we make payments to our vendors in the stipulated time, and there's no delay, etc. There's no manual intervention. So I think all of these things have helped us, and it is only going to increase. So we don't expect the cost to go up in the same proportion as which the revenue is going up. It'll be much lower than that.
Yeah, sure, sir. And sir, one last question is, what's the percentage of number of rooms? What kind of growth we should anticipate in, say, financial years 24 and 25 for EIH?
Well, are you talking in terms of growth of profitability or growth of revenues?
No, I'm talking in terms of room, the number of rooms.
No, I mentioned already, it's in 24, there is the number of rooms addition is not going to be very large, FY24. But in the last earnings call, we had mentioned the projects that are coming year by year, which year, how many projects, how many rooms. So you can refer to that document, but in quite a few projects are on the anvil in the next 2 to 4 years.
Sure. Sure, sir. Thank you very much. This is very helpful.
Thank you so much.
Thank you, Aishwarya. A reminder, if you want to ask a question, please use the raise hand function or come in directly by introducing yourself and go ahead. So while we wait, Poonam, do you have any questions?
Yeah, I do have a couple of them. Just a follow-up to the previous participants' question. Did we get into negotiation with the corporates on the rates, and is it at par with what we charge for the retail clients?
Sorry, I couldn't hear the last portion.
So is it at par? The corporate room rates have gone to that of par compared to that of retail clients, or is it still below?
No, see, corporate business is definitely more commoditized than individual FIT businesses. So obviously that will always be slightly lower than the direct rates. But yes, there is a revision across categories and across segments. And most of the contracting in case of corporates, which are, except the ones which work on a calendar year, the other corporate rate agreements have already been concluded.
Okay, and if I have to compare this with Q2FY23, what is the growth rate in terms of increase in ARR from the corporate side you have witnessed?
So I somewhat answered that question earlier on to say that our ARR, as I said, in Q3 is anywhere between 35 to 40% higher, and our 30 to 35% of our business is corporate business. So obviously there is a contribution from there as well. So I won't be able to give an exact number, but it could be in the range of 10 to 15%.
Okay, understood. Can you also talk about the demand side for the upcoming quarter, and considering that G20 things are happening, so how the demand is going to be? Your thought on that?
I can only say that we are pretty bullish about the next few quarters. We don't want to talk much beyond that, but the next few quarters we are quite bullish, barring any unforeseen kind of factor, whether it's Ukraine or whether it's inflation or recession. Barring those, I think we are looking at we are expecting good business in the next few quarters.
Sure. So I was just going through the presentation at this question. The RevPAR growth in cities such as Kolkata, Agra and Chennai markets have been lower compared to what it was on pre-COVID level. May I ask why it is so, and when can you expect the recovery in those cities coming back?
Yeah, no, you're right. And the city, these are characteristics of the city more than anything to do with our business, because in Calcutta, for instance, we continue to be STR1. So in our comp set, we are FPAR1. So despite that, the city itself, the rates are more subdued, and therefore it's difficult to say. Chennai is definitely picking up, and I think with the winter season, Trident Agra should also not be a problem. So let's look at it. I mean, on the contrary, if you look at cities like Bangalore, which is on a 90+% occupancy consistently over the last 6 months. There, of course, both the occupancy as well as the RevPAR, I mean, IRR is higher, which leads to a much higher growth in RevPAR. So I think it's more of a city characteristic than anything to do with our hotel.
Okay, got it. And also, if you can give your take on the flight catering business, how you are seeing any improvement? Are you seeing any improvement from here on? And if possible, can you please compare how second half of FY23 will be vis-a-vis first half? Given that, you know,
well, second half certainly will be positive because in the past years, the company has seen losses because of losses coming in from this segment, especially after Jet Airways, the Jet Airways debacle in 2018. After that, there was a substantial drop in the business, but yeah, it has picked up now. And this year, definitely from this segment, we will be a bit positive.
Apart from this, are we also catering to other airlines? Like we were catering to Tata's, right? Before Air India.
No. We never. There was a very stray business long back, but we never. Our clientele in OFS, in Oberoi Flight Services, 70% of our clientele is international airlines. So we have always been more concentrated on international business.
Okay.
The only addition that happened during the COVID, which continues till date, is one of the prominent domestic carriers actually approached us, and we started supplying to that business as well. But now with increase in occupants, meaning increase in utilization of our flight kitchens, I don't see any further domestic business being picked up by us.
Okay, and if you have to give the growth rate in terms of, you know, revenue and EBITDA, will you be able to comment on the number for the air catering business? Can we expect profitability from this segment?
Yeah, I did mention that, you know, we will be EBITDA positive this year, definitely, which was earlier at a loss. So I can't put a number to that because we don't declare that as a separate segment, even in our accounts. So it will not be right for me to really come out with a number, but we will definitely be EBITDA positive is what I can say.
Okay, understood. And also, India has a destination gaining traction in terms of, you know, beaches destination where we are not present at this moment, but we have a plans to get into it, especially Goa, wherein we are setting up the Trident hotels with roughly around 150 keys. I believe this is not, the hotel is not into ultra luxury segment wherein, you know, we have plans to create some kind of palaces and all. So we shall follow the same trend of expansion into another cities, or it's like we are refraining ourselves from getting into palaces kind of hotel into the beach destination. Your take on this?
So in Goa, there are two hotels. Firstly, if you look at our presentation carefully, there is one Oberoi hotel and one Trident hotel. We have a very large area there, which we own. And these two hotels are being built there. Total, it will be about 250 rooms. The both of them taken together. It will really, we don't have a segment called Palace. But if you're referring to the Villas properties, which is in let's say, an Uday Villas or a Raj Villas or a Amar Villas, for example, yeah, we are not planning any Villas properties immediately, but we will, whichever hotels we come up with. Vizag is also on the anvil through one of our associate companies, which is also a beach destination. So therefore, these will either be upper upscale or it will be luxury hotels, but it will definitely not be lower than upper upscale.
Understood. Also, there is a follow-up question to this, given that we are, you know, adding up couple of inventories into our portfolio. So is it that the occupancy going to decline from what it is presently at the peak level? Or do you expect for new Cummins hotel will have the same occupancy into place?
No, see, whichever projects we are doing, it's not randomly picked up projects. These are well-planned projects with proper focus on what we intend to do. Typically, hotel projects, normally they rationalize and they come to a normal position in the third year. But we are quite aggressive on our marketing, etc., on the new properties because they are very chosen properties. And also the destinations, if you see, really speaking, Goa, Rajgarh is one destination, of course, which is an offbeat destination and which probably falls into the category of what you were earlier calling as a palace hotel. But apart from that, I think, well, yeah, this is exactly what I would say to reply to you.
Okay. Let's say we have roughly around 8 to 9 deals under the pipeline, and if I have to compare your pipeline with that of Indian hotels, they are roughly coming up around 8,400 to 8,500 keys, again into ultra luxury and luxury segment, but we are going very slow in terms of expansion. Why is it so, and do we have any plan to scale up compared to that of peers?
Thank you for your question, but sorry, I would definitely not like to compare with anybody other than our group. We have very clear idea on what we believe others are doing and why we do not want to follow that path. And it is not true that 8,000 rooms are getting added in ultra luxury and luxury segment. If you see at your numbers, I would just request you to revisit your numbers. They are definitely a large mix of budget hotels and other hotels, and we are not going to operate in the budget category. That we are very clear.
Understood. So for clubbing, I guess you are also going to set up a club, or how do you see that you're going to scale up the club segment from here on? Because I guess 1 or 2 club thing you're going to start up, right, in this financial year.
Yeah, I think you're referring to the Bay Club.
Yeah.
So, Poonam, my request to you would be to view our groups slightly differently than what many players in the industry today are doing. So let me stick my neck out and say that what we believe, as many others doing, is commoditizing the business. We are not into commodity business. So each of our hotels will be unique hotels. Even the club that you're talking about, I think you should wait for it. In fact, it has already been launched on the 18th of this month. And I would request you to visit the club to really see what kind of a club it is. It's a completely different club. Nothing of that sort has been ever seen in India and in many other places across the globe, right? So we are into niche operations. We are not into commoditizing. We are not into volume and talking about number of rooms, number of clubs. If we do one club, then that will be very unique and that will contribute. And we believe that way we are way more profitable than if we were to go the commodity route. That's our philosophy. So I would just request that, while making, of course, we are also into the listed space. So obviously every analyst, every investor would compare that. I completely agree. But while doing that, I would just request you to bear that in mind.
Sure. So there's this news article which have been floating for this year wildflower cases. So I wanted your verdict on wildflower cases, and I have heard that the property is getting converted from freehold to leasehold for 40 years. So is it something negative for the property? Your take on this?
No, we already answered this question in the last earnings call. It is actually not negative. Firstly, the property is not getting converted. It is the land that is getting converted from freehold to leasehold. That option was actually there for us 15 years back as well. But at that point of time, the profitability of the hotel was very different from what it is now. I mean, in the year of the pandemic, the Wildflower Hall was our most profitable hotel across the group with a 52% profitability, right? So the decisions that were taken in 2015 to contest the case versus the decision now not to contest the case are equally valid. So at that point of time, there were reasons why we decided to continue with that case. But today, as things stand, this verdict is based on an arbitration award that was given out in 2005. And based on that, as we look back 15 years later, I think the terms appear to be very favorable for us. And I don't see in any way. By the way, this 40-year lease that you're talking about, it is renewable for another period of 40 years. So it's actually 80 years at of course the as per mutual negotiation between the two parties.
Also, is there any pending penalty from our side which is supposed to be paid to the government since we have delayed the construction of the property?
That has already been taken into account in the last quarter.
Okay, so there's no.
I mean, I can't give any forward-looking statement if there is anything new that comes up that I don't know. But as of today, whatever liability has accrued from 2005 to 2022 has already been considered in our books. If you look at our exceptional items for Q2, you will find the figures there.
Yeah, understood. It would be really helpful if you could give the capex, for your upcoming projects, say, over the next 2 to 3 years. Any ballpark number will also be doable.
It's a little difficult to give. See, our regular routine capex is between 40 to 50 crore. But I believe what you are asking is not the regular capex. I think what you're talking about is new projects.
Expansion, yeah.
Yeah, so I see the ballpark numbers. You can put it up. You have the number of room keys and the year, which we mentioned in our last earnings call. An Oberoi property anywhere, which is an Oberoi branded property, costs anywhere between 2 to 3 crore rupees a key. And a Trident property costs anywhere between 1.4 to 1.75 crores a key. So, and you also know which are the managed hotels and which are the owned hotels. So I'm sure you can work out from there, Poonam, if you don't mind.
Yeah, I'll work out. No worries on that. And also, how's this RevPAR trend, you're seeing in October month compared to that of September? Is it better, or like because June, July, I guess it got impacted due to seasonality, wherein, the corporate travel has been limited given that it's a rainy season, and, there are a couple of holidays which have fallen into place wherein corporate side of travel has been restricted. So if you could comment in third quarter, do you feel the seasonality will continue given that again there's this holiday season coming in?
Well, that's a plus as well as a minus. So, holiday seasons are good for our leisure hotels, and other times are better for our city hotels. And we have a fair distribution between, although 50% of our inventory is in city hotels, that's true, but or more than that, right? Really. So the RevPAR trend is in line with what we did in September. Well, in some cases, ARR is higher, occupancy is slightly lower. And as I said, that the focus is currently on ARR because we believe that throughout the pandemic, we took that decision to really make sure that we are top of the line with our safety and security measures, etc. We continue to do our upkeep of properties, and we do believe that our properties should fetch a premium in the market. So considering that, although occupancies are also quite good there, RevPAR is currently at similar levels as that of September, but that's only a trend, and I'll just request you to wait till the quarter gets over because it's in the middle of the quarter and I don't want to really make a forward-looking statement.
Sure. So I don't have any other question. Thanks for answering all of them. Hitesh, back to you.
Thank you so much.
Thanks, Poonam. A final reminder, if you want to ask a question, please use the raise hand function or comment directly by introducing yourself and your company. So I think we don't have any more questions. So we'll just conclude this now. On behalf of Nirmal Bang Institutional Equities, I thank Mr. Kolol Kundu for joining us today with all his comments and answers, and thank all the investors who joined in. Thank you, everybody, and have a good day.
Thanks a lot, Kolol. Really appreciate it.
Thank you, Rahul. Thanks.
See you soon. Cheers. Thanks. Bye. Have a good evening.
Thank you, sir.